Once again, thanks for tuning in. Holly Shields here for Kalkinemedia. What is EBITDA? Before we break it down, please give our channel a sub and hit that bell icon to stay ahead of the game. Earnings before interest, tax, depreciation, and amortization, or EBITDA, is a widely applied concept in accounting to calculate a company's cash flow and profitability. As a result, market participants and investors keep a close tab on EBITDA as it helps them make decisions about investments. Although traditional investors like Charlie Munger have expressed reservations about EBITDA, it's widely used in markets, and M&A transactions are frequently priced using EBITDA-based valuations like EV, EBIT, DA. EBITDA is a financial statistic that replaces revenue, profit, and earnings per share. It also enables us to assess corporate operations and the results of operations decisions. Non-operating items are excluded to arrive at EBITDA. It excludes the impact of capital structures or debt and equity, non-cash expenses as well, like depreciation and amortization. So how did earnings before interest, tax, depreciation, and amortization, or EBITDA, emerge? Well, in the mid-1980s, EBITDA was originally recognized as a leveraged buyout metric used by investors to assess distressed companies in need of financial restructuring. The leveraged buyout bankers highly preferred EBITDA as a method of understanding whether a company is capable of repaying its debt within that term or not. Calculating the EBITDA to interest coverage ratio, investors get a hint if the companies can pay the interest or not. Since then, the concept of EBITDA has been widely applied in accounting. However, some critics argue that EBITDA as a way of expressing business operations that ignores the operating expenses. As a result, it can become misleading to some people about the actual performance of the company. So how do we calculate EBITDA? Well, the EBITDA metric only focuses on operating income, that is EBIT, and not, on the other hand, it does not consider non-operating and non-cash expenses. The reason behind excluding such expenses while calculating EBITDA is that it calculates profitability based on operating income. It avoids discretionary factors like debt financing, capital structure, methods of depreciation, and taxes. In other words, it can be said that EBITDA represents a company's financial performance without reporting its capital structure. The formula for calculating EBITDA is net income plus tax plus depreciation plus amortization, or operating profit plus depreciation plus amortization. So why is EBITDA essential? Well, EBITDA is an important part in business as it is a method of analyzing operational performance without the involvement of any capital structure. It implies that EBITDA does not count the different ways by which a company might use its debts, equity, cash, or other capital sources to finance its operations. It's also independent of the non-cash expenses in a business, like depreciation and amortization, as it has no relation to the company's operational performance. Moreover, EBITDA also excludes taxes as it varies with time, the company's revenue, and many other factors. The EBITDA is also used at times to draw comparisons between two or more organizations regarding their operating performances. So we can conclude by saying that EBITDA is a handy tool that investors widely use to understand a company's profitability. It's so because an investor's decision is directly dependent upon the profitability of the company, and thus EBITDA reflects the capabilities of a company if it can pay interest to the investors or not. So what are the drawbacks of EBITDA? Well, the major drawback is that GAAP and IFRS do not recognize it. As a result, some investors like Warren Buffett are skeptical about using it when it comes to analyzing the profitability of an organization. It's also because EBITDA represents a company in such a way as if it has never paid taxes, interest, or anything as such, or has experienced depreciation and amortization. For example, let's assume that a newly developed startup may portray its positive sales through EBITDA every year. However, its debts, taxes, interest payments do not reflect on the EBITDA value. This could be misleading for investors, as it might appear that the startup never paid interest or spent money on debts. Well, now that you're up to speed, check out some of our other videos to boost your financial IQ. If you like this info, please give us a like, comment, and a share as well. And for regular updates, head to our website at kalkinemedia.com. This has been Holly Shields for Kalkinemedia.